Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Well, the election is over, and from a political standpoint, it was pretty much a non-event. Liberal leader Justin Trudeau has secured his third term as Prime Minister, albeit with a minority government. But from an economic point of view, higher taxes could be on the way, making some investors nervous. Joining me now with his insights on which sectors will be the winners and losers from this election outcome is Greg Taylor, Chief Investment Officer at Purpose Investments. Hi, Greg. Great to see you.
Great. Thanks for having me.
So what do you think? Are we going to see some sort of fundamental shift in the market showing up?
Well, not as a result of the Canadian election. It seemed, as you mentioned, from the economy and political point of view, a non-event. And I think the markets are going to take that as the same. I think most people have kind of driven on already. Markets generally like having more certainty. So getting the election past this is going to be a positive. But really, there were no big changes at the end of the day. So it's going to be more status quo to the environment that we've had for the last few years, hopefully without the pandemic on top of that. But there are going to be a few sectors that will benefit and some that will lose. And certainly the ones that we're worried about right now are just what's going to happen with the financials, because through the campaign, there was talk of a bank tax. So we'll see if that actually comes to fruition, but we'll be watching that from the banking point of view.
Yeah, let's talk about the banks because Trudeau did vow to tax banks and insurance companies. This is a 3% surtax on every dollar above that $1 billion. My understanding is the actual hit to the bottom line might not be that much, but there's also the sentiment to consider, isn't there?
For sure. And I think at the end of the day, we're all going to realize we have to pay for this spending at some point. And whether it's going to be a combination of the higher personal taxes or corporate taxes, somewhere we're going to have to talk about deficits down the road. So probably the banks are one area that they're looking at because they have done well and the balance sheets are flush with cash right now. But it's going to be an interesting balancing act because for most Canadians, banks are a big portion of their savings and their RSPs. So you don't want to be too draconian on the banks because that hits out a lot of savings of the average Canadian. So we will see how heavy-handed they come down on this. One of the trade-offs that are going right now is that the banks have really been told not to bump dividends or do buybacks since the start of the pandemic, and they've had a really good period of growing their balance sheets. So we are looking for them to bump dividends in the second half of the year, but that might be tempered if they have to start paying more taxes.
Greg, we know with a minority government, there's always compromise. And so we know Liberals will probably have to make some concessions, and likely the NDP, who have wanted to raise capital gains tax to 75% from 50%. So what's your take on that? I mean, I guess one, how likely, and then how much damage could that actually do?
Well, I would not be in favor of that at all, and I'm not sure that's going to surprise anyone from a Bay Street point of view. But really, the capital gains is something that I think you have to be careful with. We keep talking about trying to have an innovative economy and trying to have people start up with new businesses, but that really gets clampered when you have people that start companies, they grow them, and then they have to pay a huge tax bill if they're actually successful. So if you want to have an innovation economy, you want to have all the incentives to get that as the company's going, but also have the founders been able to reap the rewards at the end of the day, because it's not uncommon to hear companies that start to grow, and once they have a great idea, they move south of the border or to a better tax jurisdiction. So I would be hesitant on putting capital gains in place from whether it would clamp down on the innovation economy, but it certainly seems something that the government's coming after.
Yeah, I think to your point, I mean, one of the concerns that I've had is, like you said, we have 1.5 trillion dollars of debt, and you basically have three choices. You tax your way, you cut your way, or you invest and grow your way. And likely it's going to be some sort of combination. It feels like they're leaning towards the taxing your way, and obviously not as good for people's ability to save when it's already tough.
Oh, absolutely. And you don't want to make sure and we do have a threat right now of inflation coming on. So with inflation coming on, things are getting more expensive, and you really don't want to squeeze the middle class any more than it already has been, because it is going to be harder to make ends meet. And if taxes start to go higher, that's going to be another hurdle for a lot of people.
Greg, we have about 40 seconds before the break. Commodities, what's your thoughts on that? And is China a wild card here at all?
Well, China's absolutely a wild card from what we've seen, even this week with that Evergrande situation, whether that would have an impact on the construction market in China and demand for commodities. But as we go into an inflationary period, which it seems like we're entering, commodities traditionally are the area that benefits. We're seeing that in oil and natural gas, and we'll see if the rest of the
Mhm.
commodities join in.
All right. Well, hold your thoughts because we're going to continue this conversation after the break because I do want to get your take on inflation. Welcome back. I'm here with Greg Taylor. Greg, we are seeing a lot more volatility in the market. So, what do you think is behind it? Is the thinking that valuations are getting, lofty? Is it worries about inflation or something else?
Well, it's probably more of a class that we're getting closer to the end of a cycle. Markets are at all-time highs, and I think that would surprise a lot of people when you think back 18 months ago when we were entering the pandemic. We had a market's dramatic sell-off of 25, 30%. And really, there was a lot of money thrown at it from banks and central governments, and that's gotten us to where we are now, which is back to all-time highs. But we all know that stimulus has to start to end as the
Hmm.
central banks are going to start taking that away. Governments are going to start pulling back on some of that. And I think that's the nervousness that's going to start creeping into the market is, well, the question is the economy strong enough to go on its own? So that's going to cause some volatility as we get some puts and takes moving between different economic data points to see if how the economy is doing. So it does feel like we're entering a stretch where it could be harder to make money in the markets. Certainly, they're not expected to go up every day, which we've had for the last 18 months. And I think as we get into this period into year end and early next year, as we deal with the Fed starting to talk about tapering and taking off stimulus, it's going to create some volatility. And I think that's something investors need to be aware of. But it's not the end of the world. Volatility is normal in stock markets. And it's more that we're entering a more normal period than the abnormal period we've been in the last few months.
What do you advise investors right now that are heavily weighted towards equities? And do you see better opportunities in the US versus Canada?
Well, if you've been in the equity market for the last year, you've probably had a really good stretch. Markets, as we've said, are back to all-time highs. So it's probably not a bad time to question whether you want to lock in some gains. If you're overexposed in different areas, you probably want to take off some risk and maybe go into more defensive, more areas that are going to be less volatile if we do get this period of volatility. So it's probably a time just to reassess, think that we've had a really good run, but do we want to lock some of this in? And whether we want to go to the US or Canada, that's a big debate.
Yeah.
Canada's normally been viewed as a late cycle market, and that's due to the commodities and financials, which are sectors that do better at the end of the cycle.
Hmm.
But the US market, when you look at it, is really interesting because this whole phenomenon of the new tech companies, FANG's been a big area of people looking at. But when you look at the Facebooks, the Amazon, the Apples, these are really the new defensives. These companies have massive balance sheets, good dividends, and they're almost more secure than the government. So it's probably not a bad idea to keep some of the portfolio in these big cap US stocks because they are the new defensives and might be able to weather some storm if we get that coming forward.
Greg, what do you tell investors who are searching for yield? Because this is so tough for so many people unless they're willing to take a risk, which really is not ideal for those who have less risk capacity. And I say this from someone, your purpose focuses a lot on trying to create innovative products to solve some of these problems.
Yeah, yield's been a big frustration for a lot of investors is you're not finding it in the traditional sources that you used to be able to. You used to be able to buy a GIC or a government bond,
Yeah.
and that would yield above inflation, and you'd be living happily ever after and don't have to worry about it. But that's not the case right now when you've got 10-year bonds yielding 1.3, 1.4%, and inflation in the 2 to 2.5 or higher range. So you're actually losing money investing in government bonds versus losing purchasing power versus inflation. So you've got to look in different areas. Dividend equities have done well, but as we mentioned, we could be getting into a period of volatility. So while there's attractive yields, you might take on some price risk. So what we've seen a lot of people do over the last few years is move into different products, which are something like structured notes, which are areas that are linked to the equity markets, but will pay an attractive yield in the 5 to 6% range, sometimes higher. And it'll also give you some downside protection as it's linked to equity markets. So people are looking at structured notes, looking at different areas because the traditional sources of yield are just really not there anymore.
Can you explain structured notes? And I want to just bring up a board right now because Purpose has launched a Purpose Structured Equity Yield Plus portfolio. It's a mouthful, but at PSY Plus.
So what we've done with structured notes is, and the traditional structured note is a note that the banks will create linked to an underlying index. So you'd reference an index and you'd buy it at that point in time. There's always a term to these notes, which is usually 5 to 7 years. But then there's also a barrier that you have that's usually up 5% to down 30%.
Okay.
And what they do is if you're within that barrier, you will get a coupon, kind of a reward every 6 months if you're in that range. And at the end of the period, if you're within that range, you get all your capital back.
Okay.
So it's a really innovative way to get access to capital, get higher yields because they are yielding 5 to 8% across the board.
Right.
The problem for investors and advisors is that if you ever breach that upper barrier, which we've had quite often in the last little bit, you actually get called. So all your money gets returned back to you.
Welcome back to Strictly Money. Are you struggling to save more? Is the thought of putting a financial plan in place something you're avoiding or finding daunting? Our next guest says it might not be entirely your fault. Joining me now with her insights and some tips to taking more financial control is financial psychologist and family wealth consultant Moira Somers. Moira, great to have you on.
Thank you so much.
This is something I've talked a lot about and covered as a financial educator myself. So many people know that they're supposed to be saving more and planning for retirement, and yet so many people don't do it. Why is it so tough?
Well, there's so many competing demands on time, energy, and money. That it often that's just the ground on which we function. It's kind of like if you're trying to launch a rocket ship where instead of having a nice reinforced cement pad, we're on spongy, boggy soil. We don't get a whole lot of liftoff because our life doesn't often have space for it. And to create space for it, we sort of have to have confidence that it will matter, that we can do something. And sometimes people have a hugely difficult time figuring out where to even get started.
Is it about creating good habits? When we talk about habits, it's things like don't rely on willpower, take baby steps. Are those some of the things in life in general that we can apply here?
Absolutely, we can apply it here. It's also a really good idea to try and find things that you do once and then it works in your favor for years to come. Things like setting up automatic contributions to a savings program.
Mm-hmm.
You sign one piece of paper once, you check one box once, and then the default is set to work in your favor instead of a default of not saving, which works in the favor of everybody else but you.
Moira, you have a list on your site. I thought this was interesting because it's 10 skills for modern financial skills. And, there was some like saving and debt that were there. But what stood out for me is you had developing marketing skills in there as one. Why?
Developing marketable skills, yes. I think the pandemic has taught us that many of us who thought we were safe, who thought that our skills would always find a place in the modern marketplace, have found out that, perhaps not. And it's the people who've been able to often combine personal passions with things that the marketplace will pay money for, who've been able to safely transition. And so it doesn't matter how old you are, and it doesn't matter what university or college program you might be studying. We always need to combine sort of a knowledge base in something that interests us with something that there is a need for in the marketplace. And it doesn't have to be a huge need, but it needs to, specialized needs can be good too. But we do need to be sure that we're evolving in terms of our career and our marketability as people.
Yeah, the investing in yourself. You also had respectful and productive money conversations to have those.
That's a skill that we can develop over time. For those of you who have been married for some time, you may know that that's something that kind of evolves over the course of a relationship. And as you come to understand what each other's strengths and foibles are in the financial domain, you also learn how it is that you can best approach your partner and how it is that you can best manage your own anxiety or your own upset around things. You know, Sejal, every one of the things on that list is something that combines emotional intelligence with other kinds of
Yeah.
skills, right? So to have respectful and productive money conversations means that you really need to know yourself and what you want and what your triggers are and what your partner's triggers are. And you need to work with that. You need to, in order to save, you know, you need to know what are the things that knock you off the savings pathway. To invest, you need to know where is it that you tend to shut down if that's your thing, or where is it that you tend to get drawn by the shiny objects. And you need to know how to work with that aspect of yourself.
Yeah.
It's people who don't really pay attention to their own EQ that
Mhm.
often get suckered.
I
in the
think it's such an important point because sometimes we don't realize that we all have money personalities and money narratives, and that plays a role. Well, we're going to take a quick break, but when we come back, we're going to talk about how you get the right financial advice. Welcome back. Our guest this show is financial psychologist Moira Somers. Moira, you wrote a book called Advice That Sticks, and this is really about the problem of financial non-adherence. What did you see that made you write this book?
What I saw was a whole profession of financial advisors who were just so smart and so technically knowledgeable, but who couldn't capture the hearts and minds of the people that they were working with frequently. And so a lot of good advice just never got out of the gates.
So this is aimed at advisors. I'm
Absolutely.
assuming, yeah. So what are the biggest mistakes that you see financial advisors make?
I think we could have a whole call-in show on this, and people could tell us their experiences. The first is, you know, just taking up way too much of the airtime and not getting to know their clients, not getting to know what moves them, what scares them, what they're competent in, where they feel really uneasy. So talking too much is a huge problem. And when they do talk, they use jargon. They use, you know, sort of the in team, the in group language of financial advising, which as Canadians we are kind of polite people and will smile and nod even when we don't have a flipping clue what was just said. And those tendencies really are off-putting.
Yeah, I talked to so many advisors about this as well, and I think there's the technical knowledge that you said, but at the end of those solutions and the things that you're providing is someone who is worried about their future and has a whole lots of emotions that come with that, and sometimes I think advisors forget about that.
Mhm. And it's not even just the emotional life; it's just the pragmatics. If an advisor doesn't have um, any kind of tools for managing a client's to-do list, for example,
Okay.
then a lot of stuff just gets forgotten. I'm part of a company called Nudge right now, and our whole raison d'être is to help help financial advisors manage the to-do list for themselves and their clients, because forgetting is a huge problem. You know, and if there's something on that list like get your will up to date,
Hmm.
there's a little bit of inner conflict around doing that stuff, because you've got to have discussions about who's going to be the guardian for your children, or you've got to contemplate unpleasant outcomes. And so we're kind of motivated to put some of those things off, even though they're so critical. And even though it's kind of like one and done, if you can just get something out there, you're much better off than the majority of Canadians. But advisors need some tools, and some commitment as a team that they won't let that stuff just go in the cracks and never come out again.
I think that's such an important point, Moira, because on the flip side of it, the clients themselves, they also have to take that ownership and be that partner to advisors as well.
Mm, absolutely. And so when you can see that implementation is a shared responsibility, when you can view it that way, the way we do, I'm a professor at a medical school, and this is the way that physicians are being taught, that it's not enough to just give the perfect prescription. You've got to make sure that the client is willing to take it. And if the patient isn't willing to take it, then you've got to work with them around how come. And in that discussion, you may find out some really important things about the patient's life that will lead you to make a different recommendation altogether.
Moira,
And
we only have about 50 seconds or so, but what do you tell those who don't value advice, that think that do-it-yourself route is the only way? Because we are really sold on that, don't we?
there is a sort of Marlboro man mentality that you can do it better yourself. I think some people can, the majority of people can't. And if you are going to try to do it, you need to make so sure that you've got confirmation busters and access to sources of wise advice that you will follow, so that you don't get into the weeds.
And take the emotions out of it.
Mhm.
A really important one. Okay. Thanks for coming on the show today, Moira. Where can someone pick up your book?
It's available on Amazon.
Okay, wonderful. That was Moira Somers, financial psychologist. Well, that wraps up this edition of Strictly Money. If there are financial topics you'd like to learn about, or you want to give us some feedback, we'd love to hear from you. Send us an email. We'll see you next time. Until then, stay well, stay wise, and stay wealthy.